Guys, Cathie Wood has updated her price target on Tesla to $3,100 per share, which is a total of 622% return by 2030. You think that's a lot? It's 76.7% per year growth for Tesla stock. Now let's go see how Tesla is going to make this happen. Tesla stock has been on a wild ride. It hit $415 per share just 2.5 years ago, and since there has really languished. Now, perfect example of how people look at a stock, it's fallen a lot, and they start to turn on Elon. The mentality on Elon has not been as rosy as it was in the past. But don't deny, Tesla has been an incredibly fast-growing business. Look what's happened over the last 10 years. They only did $3.2 billion in revenue in 2014. Last year, $96.8 billion. That is incredible, incredible growth. From their all-time high, back around 2022 and 2021, they are up significantly higher on revenue and profit. And even more, their full self-driving system at $99 per month has been coming out more and more. That is the big key to getting very high valuations. Why? Well, guys, as I've talked about many times before, Tesla right now is a car company. Over 90% of its revenue comes from cars. I used to think it was otherwise. I used to think the services part of their revenue was their self-driving. It's not. In fact, let me show you something I found in their 10K. Services and other revenue consists of sales of used vehicles, non-warranty after-sales vehicle services, body shop and parts, vehicle insurance revenue, and retail merchandise. Mo, I was under the impression, shame on me, that services meant the FSD.
I thought it was full self-driving, the software, etc.
Yeah.
I never would have guessed that it was that stuff.
And Mo, at $99 per month for FSD, how much of this is gross margin? This has got to be insanely high gross margin.
Yeah, it's just software.
It's just software. So it's got to be 85, 90%, if not more, gross margin. So I thought to myself, oh my God, this company is going to kill it. But once I read this in the 10K, I was like, wait a second. So what is their actual FSD revenue right now? Now, the interesting part is this is an even more bull case in my opinion, because this entire time I thought they were making this crap money, even with a lot of FSD revenue, but their FSD revenue has not been high. In fact, last year, they only realized $595 million. For this upcoming year, they're expecting $926 million in revenue. That's less than 1% of the revenue coming from this really high margin business. For those of you out there who are against Tesla, this is good news because this is going to help Tesla's valuation. Mo.
Shows how much growth there is.
Exactly. Mm-hmm. There's so much growth available in this. At $99 a month, I wonder what the penetration rate is for this $99 per month. So you sit there and say, let's say Tesla gets to 10 million cars a year someday. Okay. Now let's say 20% buy full self-driving. I don't know if that's realistic or not.
It's a big number, but maybe.
But 2 million cars a year times $99 a month, that equals what? Well, $200 million a month in revenue.
That's a fantastic.
Times 12, $2.4 billion.
That's more like it. But look how crazy that number is from 926 million.
I'm looking at this going, okay, how if at 10 million cars times 20%, am I only getting $2 billion, $2.4 billion in revenue? And then they're saying in their 10K right here.
I just thought of something too.
They're saying their 10K, they're going to do 926 million this year. They didn't sell 10 million cars last year.
The thing that I just thought of was you assume they're going to sell 10 million cars a year.
Well, that's my thing. So that's why I'm not seeing the connection.
They're going to do less.
I'm not seeing the connection between how they're doing 926 million this year.
Maybe they'll increase the price.
Maybe they will.
But then how many people buy it?
These are the conundrums we're having with Tesla. Yes, there's a lot of potential for tech. And this could really drive the stock's value. Because at the end of the day, guys, if they're able to generate, let's say $100 billion a year in revenue from FSD, what does that have to equate to? $100 billion. Let's do the math real quick. Divided by 12 months is $8.3 billion a month in revenue. Divided by $99 a month is 83 million cars have to be using this.
Now, 83 million cars have to be using it. Maybe well, that's a lot of cars using it.
That's the point.
But maybe it's not just in Tesla.
No.
But still, 83 million.
I
cars.
believe worldwide, new car sales are 50 million a year.
Exactly.
So I'm looking at this going.
States, it's like 17 to 18 million, right?
It's like 17 to 18 million. I'm looking at this trying to get a grasp of Tesla. And don't get me wrong, my negativity on the stock, not the company,
right.
not Elon, the stock has been, is it possible for them to be a $3,100 per share business according to Cathie Wood? Sure, it's possible. What would that make the market cap today? $8.5 trillion, something around there. So 8.5 trillion.
So if that was today, it would be more than Nvidia and Apple/Microsoft combined.
Yeah, about the same value.
If you combine all three of them, it's about the same.
Yeah, and I'm looking at saying, okay, now let's say 70% of the revenue came from tech, from that FSD. Guys, when people value a company and say it's tech, what I hear them saying, and I want you to hear me out in this one, is saying that all the revenue comes in, you're valuing it at tech. No. You've got to value the car revenue as a car business. The tech revenue is tech business. The merchandise business is merchandise. The auto part, every single part that generates revenue, you have to value it based on the kind of revenue it is by itself.
Especially due to the vastly different margins that each category has.
Incredibly different margins.
It's nuts.
And it's funny you mentioned that, Mo. You look at automotive and services and energy generation and storage segment. Now, the good news about the energy generation, it's getting higher.
It is.
It was negative 4.6, 7.4, 18.9. But look at automotive.
It's going down.
Declining. 26.9, 26.5, 18.2. Does it have a lot to do with their tax credits? I think that was a big chunk of it. The company is still going to grow. They still make incredible vehicles. They're still the leader, in my opinion, in electric.
100%.
But don't forget, Ford just announced we're selling out our hybrids like crazy. Like, people are turning against our electric vehicles. Mo, you saw it when you're trying to sell look at mine. I have an electric vehicle.
Plummeted.
It's not a Tesla, but the value has absolutely plummeted.
My Tesla plummeted.
Plummeted in value. Again, this is short term. Tesla is still an amazing company, but they had to drop their price last year 5-6 times to get people to keep sales going, because that was very important to Elon. And look at this, Mo. The growth rate in the energy business. Look at these growth rates, 30, 40, 40, 54, 50%. That's for the growth rate for 2024. Huge growth potential. As they grow, that gross margin can keep going up and up. I think the energy level's got to get to 30 or 40% for me to start sitting there saying, okay, if maybe this is going to sound funny. What if automotive becomes their loss leader? Not literally losses, but basically, hey, let's cover our costs with the auto business and let's really make our money on energy and the FSD. I would absolutely love that. But again, then, you've got to value every piece of the company by itself and add them together for a whole entire company valuation. What I'm hearing out there from a lot of people, and people are probably hearing it from me too, it's not my intention. What I'm hearing from a lot of people is, Paul, it's a tech company, therefore you have to value it like a tech company. No, you value the tech portion like a tech company. You value the auto portion like an auto company. That's what I'm trying to get across.
It could really be both. That's the goal that they're going for.
And it'll likely be that.
Yeah.
But for Cathie Wood, and by the way, there's been a lot of criticism of Cathie Wood lately. If you remember, she sold NVIDIA like literally at the wrong time. Guys, there are plenty of things to criticize Cathie Wood on. This is not one of them. Nobody, I don't care who you are, saw what was going to happen with NVIDIA and AI. Not a single soul in the world. So when I hear, and you guys know me, I've been a great criticizer of Cathie, but I don't think she deserves a criticism on NVIDIA at all. Now, guys, a big part of ARK and Cathie Wood's thesis on Tesla is what, Mo?
She and ARK say 90% of Tesla's value and earnings will be attributable to its robotaxis business, which is yet to launch. August 8th, they're going to host an event for robotaxis.
So I love that she's looking at the future. I love that investors, you have to look at the future, because remember, every investment is the present value of all future cash flows. The interesting and unfortunate part is when you take that valuation like it's automatically going to happen. Guys, Tesla's already had issues with developing and building cars. To launch a whole robo-taxi business and say it's going to go so well that this company is going to become an $8.5 trillion business, that's hard for me to get around. And this is what I have an issue with ARK's investment and Cathie Wood's investment thesis. It's not investment. It's hope and dreams. As Professor Oswald says, a story without numbers is a fairy tale. Numbers without a story is an Excel sheet. This is a fairy tale that has to take so long to come into play. You've got to be ready for people to shift on a company like they already have with Tesla, and it could get worse.
ARK said that if the Tesla robotaxi network isn't operational by 2029, its price target would be lowered to around $350 a share.
Wow.
So they are really, really saying that robotaxi will be it.
And I want to make sure everybody understands Tesla's self-driving and autopilot is so incredibly safe. Look at this data here. Millions of miles driven before an accident occurs. Tesla vehicles using autopilot technology. Guys, look at this. 7.5 million miles. United States average, 500,000 miles. 15 times safer. Now, the thing I don't get, Tesla vehicles not using autopilot technology, it's still almost double the US average. So does that mean Teslas themselves are safer in terms of stopping a car, et cetera? Or Tesla drivers just safer drivers? I don't know. But look at this difference, guys. I don't know why Tesla doesn't promote the crap out of this information. And guys, going back to Q1 of 2021, look at the numbers. It's only getting better too. And it's substantially better than the rest of the real world. This is wonderful technology. I want to repeat that. I am not anti-Tesla. I am not anti-autopilot. I am anti-valuation. So, leads to the next question. What is the right valuation for Tesla? Now, this is a stock analyzer that we did a while back. Bo, we've got to change this drastically. The biggest parts of the change are profit and free cash flow. What I think we need to do here is do a low case where they just stay a car company, a middle case where it's a combination, 50-50 cars and sales, and a high case, which is all basically, the robo, everything is huge. Now, guys, this is all pure speculation. That's what investing is to a certain element. You've got to sit there and decide what are your ranges of potential metrics here. That's the end of the day, what you have to do. Unfortunately, a lot of people just want to believe in a story and say, and buy the stock. What you're saying there, if you do that, is no price is too high. And we can all agree that you're watching this channel, you've made it this far in the video, you know that there is a price that's too high. And if you want to get in this conversation, if you want to use these tools to become a better investor, do me a favor. Click the link in the description below. Join our community. Get all of our software. There's a great trial for 1 week. Go check it out. I guarantee it'll make you a better investor. It'll help you become clearer and have conversations with thousands of like-minded people. A lot of them in there absolutely disagree with me on Tesla. Think that Tesla is going to the moon. In fact, so much so, this is a tweet, a poll that I put out yesterday. It's not done yet. I have 455 votes on what you think a reasonable price target for Tesla is for 2030. 53% said 0 to 500, 28% said 500 to 1,000, 8.6% said 1,000 to 1,500, and 10% said over 1,500. Now, you got to remember, these people who follow me are people who agree with my valuation. They're people like you out there. So when I saw $1,500 more, I'm like, I was surprised by that. But it just goes to show there's a lot of positivity out there for Tesla. And you can engage these people in our community. All right, Mo, revenue growth. What are you thinking on a 10-year analysis? Actually, let's do the 5-year analysis because we're going to,
Okay, we're going to go 5.
We're going to do 5-year analysis. Now there's going to be, let's just do cars only. If a business becomes a cars only business, the low side.
So 7.
I agree. Okay. Now middle, revenue growth.
20.
Okay, let's go to 20. I think that's high.
What do you think it should be?
I think it should, I like 7, 12, and 20 maybe on the high side because I look at it going, even in the middle, for it to grow, that's still $5 billion a year today in extra revenue generated at 12% versus 7%. Okay. But you're smiling.
Well, because my high was going to be like 60 because I was going to do almost the same assumptions as ARK is going out.
So Mo, what'd you find on ARK Investments thesis for revenue for Tesla in 2030?
So this is an interview that Cathie Wood did, and it's on Morningstar. So we believe that the entire opportunity of artificial intelligence is going to generate revenue $8 to $10 trillion in 2030, half of which will go to platforms like Tesla. Tesla is the biggest artificial intelligence project in the world, and we believe it's going to move towards its goal of autonomous taxis.
Okay, so on the low side of $4 trillion, that's 52.5% growth, just assuming their car business stays the same. 52.5% per year. So Mo, maybe you were right about 60% because their car is going to grow too.
Right.
So let's put in 60%. I can't believe that, but let's put it in there. Now profit margin. Low side, For bottom line margin for the car business, let's go 7%. Let's go 8%.
Okay.
Combination of some AI and cars, but mostly cars. I say we do, what do you think?
20%?
Why don't we go 25?
25%?
No, let's go 20.
Okay.
And then for profit margin for the other part of the business, so, I mean, Microsoft does like 30, 35%. So maybe we should do 32 and a half.
Okay.
What do you think?
I had 40 in there.
40, okay.
Let's go 35%. How about that?
Let's go 35%.
Okay. And then for cash flow, I just did the same thing.
Exact same thing. Now PE.
So on the low end, I did 18.
Okay.
High end, I did 25. I'm sorry, high end, I did 30. Middle, I did 25. But at the same point, if maybe it's worth more than a 30 PE if they crush it like that. I don't know.
And I did my 9% desired return. So this is assuming just the market return. I think the number's going to all be green here.
This is going to be awesome.
Hit the analyze button. Oh, look, you've earned 200 points today from my active stock analyzer. Oh my gosh. Well, that means today you can pay $2,000. That's not even 5 years from now price.
Today.
But in the middle, guys, a combination of them, there's some upside here. So guys, it's all about how you look at this whole entire business. We can make any story up, any fairy tale up. The question is this probable? It might be possible. Is it probable? That's the question you have to ask yourself. So if you want to see where we did a deeper analysis on Tesla stock in the past, watch this next video. Thank you very much for your time.